It is 2008. A man named Richard Fuld is sitting in a congressional hearing room in Washington, D.C. He is the CEO of Lehman Brothers, the largest bankruptcy in American history. The company has just vaporized $600 billion in assets. A congressman leans into his microphone and asks, "Where did the money go?" Fuld pauses, and then he says, quietly, almost to himself, "I don't know." That is the honest answer. He does not know, because the money was never quite real to begin with. And that is the thing about modern banking that nobody wants to say out loud, not in textbooks, not in press releases, not in the polished quarterly earnings calls where men in suits use words like liquidity and capital ratios like they are casting spells. Here is the thing they are not saying. Banks do not lend out money that people have deposited. Read that again. Banks do not take the money you put in and then lend it to someone else. That is not how it works. That has not been how it works for over a century. And the actual mechanism, the real one, is so simple, so audacious, and so quietly legal that most people, when they finally understand it, go through 5 distinct emotional stages: confusion, disbelief, a strange kind of calm, then anger, then a much more complex calm where you start to understand why the whole system is built on a particular kind of shared fiction. This video is about that fiction, how it works, who benefits from it, what it has built, and what it costs. Stay with me. The story you were told. Let us start with the version of banking that gets taught in school, because it is not completely wrong. It is just incomplete in a way that fundamentally changes what you think you know. The story goes like this. You deposit $100 in a bank. The bank takes that money and lends 90 of it to someone else. They keep 10 in reserve because regulations require it. That borrower then spends the $90, and it ends up in another bank, which lends out 81, keeps 9, and so on. Each dollar gets multiplied around and around the system, creating what economists call the money multiplier. In theory, your original $100 could eventually support roughly $1,000 in total deposits across the whole banking system. Clean, logical. The Bank of England, one of the oldest and most respected central banks on the planet, blew this model apart in 2014. They published a paper, not a radical academic paper from some fringe economist, a paper from the actual institution that oversees the British financial system. The paper was called Money Creation in the Modern Economy, and in it they wrote, and I am going to read this carefully, "The reality of how money is created today differs from the description found in some economics textbooks." They went further. They said that the money multiplier model, the one in basically every introductory economics course, is, quote, "not an accurate description of how money is actually created." That is a central bank politely saying that what most people believe about money is incorrect. So what is the correct description? How banks actually create money. Here is the mechanism, and once you see it, you cannot unsee it. When a bank makes a loan, it does not take money from one place and move it to another. It simply creates a new deposit, simultaneously, from nothing. You walk into a bank, you ask for a $100,000 mortgage. The bank approves you, and then, this is the part, the bank types $100,000 into a computer. Your account now shows $100,000. That's it. That's the moment of creation. There was no prior $100,000 sitting in a vault. There was no pool of other people's savings being directed to you. The bank wrote a number in a ledger, a digital ledger, but still, and that number became real money the moment it was written. The loan is an asset for the bank. The deposit is a liability. They appear simultaneously on opposite sides of the balance sheet. The whole thing is brought into existence at the stroke of a key. This is called credit creation, and it is not a loophole. It is not fraud. It is not some shadow banking conspiracy. It is the officially sanctioned, legally authorized, widely understood by economists, but rarely explained to the public mechanism by which roughly 97% of all money in modern economies is created. Not by governments, not by central banks, by commercial banks. Every time a bank makes a loan.